Guy Spier built a $500 million hedge fund by mastering one of the hardest disciplines in finance, doing absolutely nothing. He modeled his career so closely on Warren Buffett that he and a partner once spent $650,000 at a charity auction just to sit down and have lunch with him. Spier practiced pure value investing. It's a strategy defined by an intensely low time preference, where you trade the gratification of spending cash today so that your capital can compound into massive wealth over the course of decades. Everything about his life and the aquamarine fund he managed was meticulously designed for a horizon 30, 40, or 50 years out. He operated with the certainty that time was on his side. But that worldview and the immense wealth it generated rested entirely on one fragile assumption, that he would actually be there to see that future arrive. On a cold November day, while driving back from a family ski trip in the Swiss Alps, that assumption vanished. Sitting next to his wife, Spier suffered a violent grand mal seizure. He woke up in a Zurich hospital to the results of an MRI. He had grade 4 glioblastoma, an aggressive and relentless form of brain cancer. The mathematics of the disease are brutal. The median survival rate for his specific diagnosis sits squarely at 14 to 15 months. Almost overnight, a man who had dedicated his entire adult life to the power of compounding interest was stripped of the exact resource compounding requires. He had to figure out how to invest and how to live when his timeline had effectively been deleted. This graph illustrates the term discount rate. It measures how we value a reward based on distance. When a timeline is blocked by a terminal diagnosis, future payouts drop to zero. The only logical move is to pull that anticipated consumption into the present. For Spier, a lifelong saver who rarely indulged, the math dictated a radical shift in behavior. He began flying NetJets, booking first-class tickets, and uncorking expensive wine on a random Tuesday. Because he could no longer guarantee his own future performance, he took the extraordinary step of shutting down his fund entirely, returning $500 million to his investors so he wouldn't live a double life. When time becomes your most scarce asset, delaying gratification is no longer a financial virtue. It becomes a fatal mathematical error. Free from managing outside capital, Spier turned his analytical investor's mindset toward the medical landscape of glioblastoma. This animation illustrates the emptying bathtub theory. Rare diseases act like a tub with a wide-open drain. New patients pour in, but die so fast the population is pulled out before the tub fills up. They never form the critical mass to attract R&D funding. This leaves potential cures stranded in what the industry calls the valley of death, the precarious gap between early preclinical research and phase 3 trials, where investment capital completely and suddenly dries up. For decades, Spier built his fortune buying safe, predictable, cash-gushing businesses like Coca-Cola. Now he's actively exploring how to fund early-stage experimental biotech trials. These medical investments offer entirely binary outcomes. They either cure the patient or they fail completely. But when your only desired return on investment is extra time on Earth, it is the only rational capital allocation left on the board. Spier explicitly rejects the narrative of battling cancer. As Warren Buffett once wrote, the Grim Reaper's batting average is exactly 100%. Mortality always wins in the end. Instead of a tragic battle, Spier reframed his survival as a daily game. The objective isn't to defeat death, but simply to score as many points against the Reaper as possible while you're still playing. In his new reality, a point is scored by the smallest victories, going for a 1-kilometer run, stringing together a clear sentence, or having a seizure-free family meal. By reducing the overwhelming scope of a terminal diagnosis down to a daily point-scoring system, he neutralizes the terror of the final outcome and reclaims total agency over his present day. In the end, Spier points to a source of strength that has nothing to do with finance or biology. He credits his resilience not to innate courage, but to the unconditional love of his family, a daily dividend that makes his bravery possible. The lesson of the Aquamarine Fund is that value isn't strictly something you accumulate for a distant tomorrow. It is something you must accurately price in the present, before a diagnosis arrives to do the math for you.